And as Nicholas mentioned in his first slide, the point of these markets, in the end, of course, are to reduce emissions. And so we're trying to track not just the transactions in the market, but also the numbers of credits actually retired. And that means that a credit can no longer be sold again. So with this slide, we've asked people not only how many times has a credit been transacted, but asked suppliers how many of your credits were actually retired. And this information is really difficult to find because many suppliers, even if they're willing to share how many credits they sold, they don't know what happened to their credits after they sold them. So they don't know if they were resold or if they're retired. So in both 2007 and 2008, we found about 12 million tons of credits retired, which would mean that in 2008, a credit was transacted over 4 times. I think in reality this is a very conservative number and that more credits have actually been retired than we know of because of the difficulty of finding this information. But again, just to keep in mind the point of even taking the context of the size of these markets and looking at their real emissions impact, it's more important to look at the retired credits. And this one, sorry, it's a little bit difficult to read the print on the screen. What I wanted to do was show where the credits were coming from and what type of credits were being sold in the over-the-counter voluntary market. A couple key themes in 2008. One was that we saw a huge increase of renewable energy, credits coming from renewable energy projects. And a lot of these projects were coming out of Asia. We also saw a fair amount of methane, which is this sort of yellow-orange, and that was coming out of the U.S. And one reason for this trend is that a lot of the U.S. transactions are for pre-compliance markets. People are betting that offsets purchased in the voluntary markets now could be eligible under future regulated U.S. markets. One of the standards that is likely to be accepted as a standard for offsets in a future regulated market is something called the Climate Action Reserve, which has a protocol for methane. Hence, you can see one of the reasons a lot of people like U.S. methane is this hope that it could be sold in the pre-compliance. As far as the renewable energy coming out of Asia, a lot of those credits are something called pre-CDM credits. So while companies or projects are waiting in the Clean Development Mechanism pipeline, they're creating emissions reductions. Those emissions reductions can be sold as something called VER, so verified emissions reduction, into the voluntary carbon market. And so who's driving this, this quirky voluntary market? And we found that the majority of buyers in the market are for-profit businesses. Some of these businesses, about 35%, are buying the credits with plans to resell them, either to a pure voluntary buyer or in a compliance market. The other 29% have purchased the credits but are retiring them for their own uses. So they're going carbon neutral or offsetting flights. There's been a lot of attention to the role of individuals in this market, so people buying these to offset their cars or giving them as gifts, but it remains a really small fraction of the transactions, not surprisingly, since people buy such lower volumes, around 2% of actual final demand, as far as we've been able to track. So finally, a couple key themes that we're seeing in the voluntary markets this year. One is that earlier I mentioned the variety of controversy around the voluntary market. So tons of different headlines criticizing the market, especially in 2007. What we're seeing is that those headlines have decreased, but the credibility, how do you create a viable offset in the voluntary market, is still a huge focus of the market. A lot of people are spending a lot of time looking at standards and different third-party standards and how do you create a viable offset in this market, as well as ways of tracking the markets through registries, and so on and so forth. There's also, as I mentioned earlier, a lot of innovation going on in this market. So, for example, avoided deforestation or reduced emissions from deforestation and degradation is a big issue in the international negotiations around Kyoto, and how could carbon markets be used to reduce emissions or to reduce deforestation? Are they the appropriate tool? Right now, the only place you'll find avoided deforestation credits being sold is from the voluntary market. So right now, regulators are looking to the voluntary market and trying to take lessons learned from those transactions that have been done. Huge question that comes up a lot around the voluntary markets are, well, will these markets exist if U.S. regulation comes into place? My sense is that yes, they likely will. One reason is that we also looked at where buyers are coming from in the voluntary markets, and actually the majority of buyers were based in the EU, despite the fact that there's currently climate regulation in those countries. And so those buyers were doing it because they weren't directly regulated or because they wanted to go above and beyond, or in some cases they were also buying U.S. pre-compliance credits. But still it shows that, yes, this market can exist alongside a regulated market. And then finally, one of the key themes is that buyers are learning more and more about the market and increasingly savvy. So 3 years ago, just to buy carbon offsets and go carbon neutral was kind of the edge and very trendy. And now customers are saying, you know, we'd actually like a specific type of credit from a specific location with a specific standard, which just shows an increased knowledge of